Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 9, 2023. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? The first thing we notice, the first thing that jumps off the page on the daily chart is the narrow ranging day we had. Yesterday was a narrow ranging day. Today was more of a narrow ranging day. The market's waiting on something. What are they waiting on? We've got CPI tomorrow on Wednesday, and then we have PPI on Thursday. Both of these data releases at 8:30 a.m. Eastern Standard Time can move the tape. They're great excuses to move the tape. What else do we have on the docket? We have the fake debt ceiling meeting with the politicians in the White House Oval Office. It's a photo op. It's nonsense. They're coming to no agreement anytime soon. Generally speaking, on the debt ceiling debates, they're going to bring everything to the end. They're going to bring everything to the brink before they make a deal. They may even shut the government down for a while. It's possible. It's all part and parcel to the dog and pony show. What else do we notice from a big picture perspective? Yesterday and today were two very narrow-ranging slow days. Whether or not we have one or two more, what generally follows a narrow-ranging slow day? An expansion in range and a much more volatile day, much more volatile period of time. We have volatile periods, we have slow periods. One follows the next. The next thing coming, when it comes sooner than later, is going to be an expansion of volatility and an expansion of the range on the chart. Period. Full stop. We're going to take a look at some other charts, use them as lesson and teaching opportunities. But before we do that, let me just ask a brief question. I want you to note it in the comments below. For those of you inside the numbers and inside the numbers live room, did anybody make money today on the trade that was put out before the opening bell? That's called a teaser. We'll get to that in a few moments. Do we see anything material on the 240-minute chart? Not really. When you look at the big picture, they tested this breakdown candle high. They had a nice big up day on Friday, and that really is this candle here. And they've just been eating time off the clock. That's it. What do we see on the 120 chart? And for me, it begins to look slightly different than the 240. What you have here is a gap lower this morning, and you have a bear flag, a sideways eating time off the clock situation right above the convergence of these moving averages. So what we'll say here is if you give up these moving averages and the market sells down, whether it be on the CPI news or some other reason, you wake up to a gap down, whatever it is, the market getting below those moving averages will open the door for this breakup candle low, or at least in the vicinity of it. Doesn't mean it has to get there. It means the door is open to get there. And that is reconfirmed on the hourly chart. And the hourly chart is interesting because this is really right out of the course. Lazy E-mini trader, you have a little bit of a breakdown candle here. Now, after that, you have this wedge pattern, this bear wedge pattern that did what? They ran a test of the breakdown candle high they couldn't close above, and guess what happened? They gapped lower. Not always will you get a gap lower, but a move lower when you can't get through one place. What happens? Well, they have to turn around and go to another place. That's what Mrs. Market had to do. Whether she's going down and is rejected from support to go back up, or going up and is rejected by resistance to go back down, either way, if the market can't get through one place, it's going to go back to another place in the other direction. Now, following that, we've had another bearish, flaggish kind of thing, eating time off the clock all day today in this very narrow range, and they're going to move them likely tomorrow, likely on the CPI data. If they pop them up, they come up to fill the gap, and maybe it's really strong and they keep going. If they drop them down and get below the moving averages we talked about on the other chart, and including this 200 period moving average, then of course the door opens for the breakup candle low, and this one on the hourly chart is the same as the last one we looked at on the 120 chart. Anybody make money today? I'll ask it again. Put it in the notes, put it in the comments. You can read the rhetoric, pause the video at your leisure. In addition to, as I scroll up, pause the video, read the notes, go back to the charts. We're going to highlight one important thing today, which was the trade, the resistance areas, the important numbers. The rest of it, you saw the narrow range. There was nothing to do all day long when the market is playing ping pong back and forth in a very narrow range. It's a sleeper tape. And one thing that we know from inside the numbers, inside the number live room is this. Never short a dull tape. Not that it won't work, but it's called the torture trade. We don't need that trade. We only want to take what Mrs. Market is providing us in the way of opportunity. We only take what we want. We don't take what we don't want. We don't chase the market around. We don't invent trades out of thin air to be in a trade rather than to be in the correct trade. These are some of the alter ego things being discussed every single day in the live room to keep all the members that are trading with me centered in what we're doing. How do you like dem apples? The morning started out at 0 dark 30, and I really had on the board a bear pivot and a bull pivot. And you can read this for yourself, but that changed around 8:15, update and adjustment. 1150 from yesterday, 41150. For now, we'll adjust the pivot from bull bear to 41150. We think better in pictures. Right of the vertical is today's activity. 41150 is the horizontal line running across the screen. And we certainly were successful today in identifying the pivot. They didn't get very far from the pivot. 41150 was in fact our pivot. Below, and the door opens for 41080 to 41020, it's a zone. Above, meaning above 41150, and they can fight back or float back to the flat line or the gap. They didn't do that, but they could have done that. 8:15 a.m. 9:17, what's the scoop? We'll keep it simple. The zone between 41080 and 41020 is support with the big fat round number underneath. That's a safety net, just 20 cents below. So I have an important number, which has nothing to do with the 410 big fat round number. So it gives you a little bit of added confidence down there that there's going to be a bull-bear battle at minimum. And here's the kicker. 9:17, there should be a bounce back in the other direction for a scalp with potential. 410.80 was the first place 60-cent spread. How you doing? Nailed the low of day in the first candle of the day. We got the rip back up in the other direction. It was good for 10 points. Some traders got less. Some traders got the whole thing. Some traders hold a trailer. Some traders take a scalp. We've got something for everybody, but we had widespread participation. Now, by the way, look over here in the middle. What was the low over here? 410.81 against 410.80. What about at the end of the day? What was the low? 410.81. Anybody think that number's important? Where did these numbers come from, you ask? It's called FM. It's mathematical. FM, as in Frank Mary, stands for Farkin Magic. The rest is history. Pause the video, read the notes, go back to the chart, and double check the work. You'll see here, 411.50 is overhead resistance. Holding a trailer is fine. The rest is trader's choice. That was all within 13 minutes of the trading day. Pause the video, read the notes, go back to the chart to double check the work. Everything you need from an intraday trading perspective is in here, especially the last post of the day, which is the afternoon schematic. We had some stocks on the move today, 4 on the board. One hit its entry objective. It was PayPal. We'll take a look at that chart. And as you know, we take a look at the good, the bad, and the ugly. PayPal was not a winner today. It did not work. Some traders made money because they waited for the second number. There are a faction of traders in the live room that do that. We've talked about that before. There's something for everybody. I provide the numbers. Traders can install their own system, their own comfort level around the numbers, around what I teach, to where they're comfortable for their own risk tolerance and what makes them comfortable participating. However, if you took the first number and the second number, they didn't really get you out of the woods. So therefore, we're going to call this one not necessarily a big fat shitburger. It was more of a untasteful slider. That's what we have stops for. It wasn't a big loss any way you look at it. It just didn't work, didn't bounce. We move on. We already know not all of the trades are going to work 100% of the time. That's an impossibility. The majority of them work. What's going on over in Camp IWM? Well, nothing. They filled their gap left open from yesterday, but they had not necessarily the same type of narrow ranging day in proportion as the SPY did, but nevertheless, they didn't really do anything at the end of the day. They're still essentially eating time off the clock underneath the moving averages, and we can't help but notice and we can't help but know about the weekly chart. This is a pattern that will either break the chain by getting above these moving averages and start running a test in the vicinity of the high of this breakdown candle, 190, 188, 187, 189, something up in there if they do that, or it's going to break down and there's another leg lower coming. And if that happens, the entire market's going with it in either direction. The IWM is not going to be headed down to 160 or 150 something, and the other parts of the market, meaning the S&P and the Qs and all that stuff, they're not going to be going in the other direction. That's not the way it works. Little bit of a down day for the folks down at the transportation department. Below all the moving averages, bearish. The trend is your friend until your shit gets thrown out the window. We talked about this weekly chart last night. You have a situation inside of a situation from a short-term perspective on the weekly chart, which is the last couple of months. You're eating time off the clock inside of this last break-up candle. They tested the low. They're holding the low. That's something for the bull case. They can't sustain price above, on the monthly chart, the 20-period moving average, 20-month moving average. And what you have here is a high, lower high, lower high. That's a bearish situation. What about the Q people? Well, on a relative basis, they were down a little bit more than the S&P today. However, again, look where they are in the chart. Totally different than all the other charts. However, we will note that this is lifted. We talked about this in the room today. We talked about it last night. There's only a small handful of stocks out of all the stocks in the NASDAQ 100, in the NASDAQ composite. There's only a handful of stocks that are pulling this up. The breadth is not great in the NASDAQ. Here's a picture of the composite. It pretty much looks the same as the Qs, by the way. Or does it? So check this out over here. Here's your former high, okay, back in February. And they've already retested this high in the NASDAQ composite a number of times. They're eating time off the clock. They can certainly make another leg higher. But we're talking about breadth right now. Now, when you flip back over to the Qs, here's that same high in February, and we've already exceeded that high. And the reason is, or one of the reasons, if not the reason, is because of the certain amount of stocks, your Microsofts, your Nvidias, your Amazons, and whatever else is in the top, let's just say 7 to 10 issues in the Qs. They're pulling it up, causing the divergence between where the Qs are and the NASDAQ composite. About the XLF, the financial space, not a lot of movement today. A little bit of down, a little bit of up, but nothing with conviction, nothing of conviction. Look at the volume. Look at this decreasing volume compared to over here when there was better than average daily volume. This is the 60-day average, this black line running across the volume. And you can see when you exceed the average volume, you have something on your hands of a market that has participation. But when you have decreasing volume and it's half the amount of the average daily volume or less than that much, there's no or lack of market participation in that market. That means no conviction with lack of participation. Smash mouth down a little bit today. This is our concern. Even though it's Tuesday, this is our concern. If they give this up on a weekly basis, which they fought 3 weeks now, the first time they hit it on top of it, that was on the week ending the 21st of April. Then they spiked it. And both weeks they closed back above. If this week they do the same or they get below, that's going to tell us something important about the semi space. The semi space is a really, really great proxy for the tech space as a whole. And if the semi space is doing one thing, likely story is the rest of the market's going to or already is following suit. So if semis are unraveling, look for an unraveling. If semis are spiking higher, look for participation to get more broadly if it isn't already there. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.